Capital financing. In this chapter, we're going to look at how a company funds the purchase of assets or investments in projects. And it chooses between two different types of capital. It chooses between equity, which is ownership, and debt, which is borrowing. So as a refresher, when a company makes a capital investment, it's building the assets of the business. When a company uses capital financing, it's going to increase either the debt or the equity in the business and balance the balance sheet out. In the coming lessons, we'll be looking at different types of debt and equity that companies can use to fund the purchase or the investment in these assets. Let's look at the business life cycle as it relates to a company's capital financing options. If you look from left to right on this chart, you have a company life cycle that begins with a launch, then growth, shakeout, and maturity. The first metric that we can plot on this chart is sales or revenue, starting from zero, ramping up through growth, plateauing at maturity, and potentially declining or extending through a life cycle extension and continuing to grow from there on. Beneath that, we have profit. Profit lags revenue, as companies typically take a while to grow their revenue beyond their expenses after they launch. And then finally, we have cash flow. Cash flow lags profit because initially, capital is required to make investments, which pushes cash flow more negative than profit. But in later years, the benefits of those capital investments kick in, and cash flow will actually outpace profit. So we have this general life cycle of a typical business, and this is just a broad generalization. But if we use this business life cycle as a framework, we can then plot on the same chart the general business risk over time, which is extremely high when a company launches and is unproven, and declines over time as it matures. Now, it may go back up again later if it's truly in decline, but generally speaking, business risk is declining over time, which means there's an inverse relationship to a company's ability to get debt funding. A brand new startup is almost surely unable to get debt financing and will have to be all equity, whereas a mature, established business is able to use a lot of debt funding and might not have to use as much equity, although equity is generally available across the entire life cycle. So we can think about this in the coming lessons as we look at capital financing alternatives for companies and for projects or investments of any kind. Simply put, the capital structure of a firm is the proportion of debt and equity that it's used to fund its operations and finance its assets. So to optimize the capital structure of a firm, companies decide if they want to add more debt or add more equity. Here's an example of a company with $1,000 of assets that has a low degree of leverage in its capital structure. So it has $800 of equity and only $200 of debt to fund those $1,000 of assets. Now let's look at the same company with the same assets but a different capital structure. This time a high degree of leverage is flipped with $800 of debt and $200 of equity. So here's an example of how a firm can finance the same assets with a different proportion of debt and equity. Generally speaking, the optimal capital structure has a number of factors. One, the current economic climate as to what type of funding is available. The business's existing capital structure, perhaps it does not have any more room for additional debt, or maybe it does. And then the business life cycle stage, which is a proxy for the overall risk of the business. Having too much debt, on the one hand, increases the risk of default. But having too much equity may dilute earnings and may not create as much value for investors. So it's important to strike the right balance between debt and equity. Ideally, a company wants to lower its cost of capital. So it uses a combination of debt and equity to hit the sweet spot where cost of capital is the lowest. In this diagram at point A, a company is all equity financed. And since the cost of equity is higher than debt, this is a fairly high overall cost of capital. At point B, on the other extreme, the company is almost all debt financed, which makes the company very risky because it doesn't have an ability to service that debt. and so the cost of capital is high again. But in the middle at point C is a sort of sweet spot where debt and equity are properly balanced, and the cost of debt, which is lower than equity, brings down the overall weighted average cost of capital. Weighted average cost of capital is simply the proportion of debt and equity a firm has multiplied by their respective costs. The cost of equity is the required rate of return that shareholders expect for investing in the business given its level of risk. The cost of debt is the required rate of return that lenders want for investing in the business given its risk. Ultimately, firms want to have the lowest weighted average cost of capital as possible. All else being equal, using a lower weighted average cost of capital or lower discount rate increases the value of an asset. Now let's look at an example of how to calculate WACC using the formula. We've got the formula written above, and now let's look at some specific numbers. Here's a company with $225 billion of assets, funded by $32 billion of debt and $193 billion of equity. That translates to 14% debt and 86% equity in terms of the total capital. The cost of debt is 3.5%. The cost of equity, or required return for shareholders, is 9%. Now we multiply each of these out. We then add them up, and we get the weighted average cost of capital of 8.2%. To learn how to calculate WACC from scratch using the full formula, be sure to take our Business Valuation Modeling Fundamentals course, where we will provide many examples and detailed calculations of how to calculate WACC for a company. In the coming lessons, we're going to look at how a company can optimally finance its business through a mix of debt and equity. At the bottom of the capital stack, we have equity, which is the highest risk and highest expected return. Then we've got subordinated debt, which is less risky than equity and less return profile. And then above that, you have senior debt at the top of the capital stack, the most secure, the safest, and the lowest expected return. So in the coming lessons, we're going to break down each of these three sections of the capital stack. We'll start at the bottom with equity, typically the first piece of financing that a company gets, and the highest risk and reward profile. Then we'll move up all the way to senior debt, the safest being the last one that we cover. All of these various types of funding can be easily understood through the lens of risk and return. As long as we understand how risky the type of capital is, we can appropriately price it in terms of the expected rate of return that should go along with it. Let's look at the various types of equity that a company can raise. Broadly speaking, there are three types of equity. Common shares. These shares represent the last liquidity position for investors and have the last dividend-paying position. What that means is they're left with whatever remains if a company is ever sold or liquidated after all of the debt is repaid and all of the other types of equity are paid out. The same goes for dividends. After a preferred dividend is paid, whatever's left remains for common dividends. Above that, we have preferred shares. Preferred shares have a higher liquidity position, which means if the company is sold, they get paid out before the common shareholders. They also have a higher dividend priority versus common shareholders, meaning they would be paid a dividend before any common shareholders. And then above that, you have the highest equity liquidity position in a shareholder loan. There is no dividend attached to a shareholder loan, but it can pay interest. When a company is raising money, it will have to weigh the pros and cons of each of the various types of equity. It will look at the cost of each type. Perhaps the common shares are extremely costly with the highest expected rate of return, so the company prefers to avoid them. Or it could be the opposite, that the preferred shares are so costly in terms of their dividend requirements and liquidity positions that the company would prefer to issue common shares. Of course, it all depends as to where investors are willing to invest and where the company is willing to issue shares. And when there's a match and the company and the investors are aligned, then they have a deal and they're able to raise money at that category of equity. Sources of equity capital. Broadly speaking, there are two main sources: private markets and public markets. Within each of these, we'll take a look at how a company typically progresses. At the very beginning, companies are often funded by their founders or friends and family. This will be the very first capital that's put into a new business. From there, as the company grows, it may reach a stage where it can raise venture capital money. Venture capital is still very early stage for extremely high growth businesses. Moving on from venture capital, as a company matures a bit more, it may make sense to raise money from a private equity firm. Private equity firms vary in terms of their strategies, with some investing quite early stage with high risk and high growth, and other private equity firms investing in more mature businesses that are stable and predictable. So private equity is a very broad category, but generally speaking, it's more mature than venture capital. So in terms of private markets, these are your three basic categories, with each of the categories having many subcategories underneath them. So in all three stages here, companies are able to raise private money from different types of investors. Then at some point, they may go public with an initial public offering or IPO. Then they can raise equity capital from institutional investors, which make up the bulk of the public markets, and from retail investors, which make up a smaller portion of public markets, but are also important for raising money for companies. So as you can see, the sources of equity that a company has available to it largely depend on the stage of the company, whether it's a public or private company, and whether it's very early stage or whether it's grown to a state of maturity. Let's take a closer look at private equity and venture capital firms. They typically invest pools of funds that represent opportunities to earn high rates of return, but that take high risk. They then exit those positions anywhere from 5 to 10 years later via an initial public offering or sale to another private equity firm or a strategic buyer, etc. There are generally two types of private equity. The first is venture capital, which is the early stage, high growth, high risk businesses. Examples of venture capital firms include Sequoia Capital, Y Combinator, and Andreessen Horowitz, just to name a few of the more commonly known ones. And then the other category is buyout firms. Buyout firms invest in more mature businesses where they use a lot of leverage, and they try to maximize the internal rate of return that they can earn by borrowing money and leveraging up the company. Common examples of buyout firms include Blackstone, KKR, and the Carlyle Group, just to name a few of the more prominent private equity firms. So as you can see, there are two general categories, but within each of these categories, of course, there are many different types of strategies and different approaches to investing. One thing that both groups have in common, though, is that they typically plan to exit anywhere from 5 to 10 years after making their initial investment. So in terms of an exit, they can generally have a total exit or a partial exit. Let's take a closer look at what that means. A total exit would be selling the entire company to either a strategic buyer, which is another operating company, or to a sponsor, which would be another type of private equity firm. On the partial exit side, you could have a private placement, which is where some of the shares of the company are sold, either to a strategic buyer or to a sponsor. There could also be a restructuring of the company, where some new investors are brought in and some old investors are taken out. And sort of as a hybrid between a total and partial exit, you have a flotation or initial public offering, which is where the company goes public. And depending on how the IPO is structured, there may be a large secondary component, meaning that the initial investors are selling a lot of their shares. Or it may be that the company is mostly raising new money and the initial investors are not selling so many of their shares. So it really depends on the initial public offering and how many of the original investors are selling their shares into the IPO. Because of the fairly fixed time horizon that private equity and venture capital firms have, these types of investments are very different from the typical institutional and retail investors you'll see in public markets. We can look at the use of debt from two different lenses. The first is from the corporation's point of view, and they use debt for two reasons. One is to lower their cost of capital, and the other is to avoid equity dilution. So that's from the point of view of the person that is raising money and using the debt for their operation of their business. The other lens that we can look at it through is from an investor's perspective. An investor may use debt to increase their equity return, so they have to put down as little equity as possible and fund the rest with debt. So let's take a closer look at what we mean with some examples. Here is a graph of a firm's weighted average cost of capital on the turquoise line. At point A, it's funded exclusively with equity. At point B, it's funded mostly with debt. And you can see that the cost of capital is high about those points, but the sweet spot in the middle is where it uses the optimal amount of debt to lower that cost of capital. All else being equal, an investment with a lower cost of capital will have a higher net present value. So it creates value for the corporation. Now, from an investor's point of view, if they were a private equity firm that was going to buy a company and they could fund it, as you can see here, with some equity and some debt, and then they were to invest for 5 years and the value of the company were to grow, but they were to pay down the debt, you can see that when we look into the future, the equity return is much greater than the return for the overall company. Because the debt was repaid, the equity piece grows disproportionately. So the equity rate of return is higher. So that's why an investor would borrow money. Just as you would to use a mortgage on your home, private equity firms use debt to increase their equity returns. Assessing debt capacity. Once we know why it makes sense for a company to take on some debt, we have to figure out how much debt it makes sense for the company to take on. So we can look at some general measures such as the company's profitability. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is one of the most commonly used metrics. Lenders will also look at the company's volatility of EBITDA to see how stable the business is. It will also look at the company's capital expenditure requirements, any cyclicality, risk in the industry, and the level of competition, among many, many other things, to assess the overall attractiveness of lending to this company. Lenders can also look at balance sheet measures, such as the company's debt-to-equity ratio, debt-to-total capital ratio, debt-to-assets, and other balance sheet ratios. This is just giving you a quick flavor of how lenders might look at a business. And then moving on from the balance sheet, they can look at cash flow measures, such as the company's total debt to EBITDA, senior debt to EBITDA, net debt to EBITDA, cash interest coverage, and EBITDA minus CapEx divided by interest, which is the interest coverage ratio. There are many more ratios that we cover in our Financial Analysis Fundamentals course and other financial modeling courses. But as you can see, there are quite a few ratios and quite a bit of analysis that can be done to figure out how much debt capacity a company has. At the end of the day, it's a balancing act. Lenders want to make sure that they're going to be repaid the capital that they've lent to the business. The business also wants to make sure that it can repay the capital, but it does want to try to maximize, generally speaking, the amount of debt that it can handle. And so it's a balancing of all of these measures to figure out the right amount. Let's take a closer look at the senior debt section of a company's overall capital stack. You can see here the components of senior debt. It could include things like a revolving line of credit facility from a bank, also called a revolver, and then a series of term loans. Term loans have a fixed schedule where they repay or are amortized and have a final principal repayment. And they could be stacked in terms of term loan A, B, C, and so on. In terms of the capacity for senior debt, typically, banks and other lenders will provide 2 to 3 times a company's EBITDA. They may require 2 times interest coverage to satisfy their requirements. And you can typically find senior debt at commercial banks, credit companies, and insurance companies. Senior debt ranks first, so it's always going to be paid out before any other lenders and well before equity. Senior debt may or may not come with guarantees from the business and its owners. Now let's take a look at the middle of the capital stack where we have subordinated debt. As you can see here, there are various types of subordinated debt or sub-debt that sit between senior debt and equity. As with the whole capital stack, you've got increasing subordination as you move down. which means you also have an increasing return profile and increasing risk as you move from top to bottom. So you can look at the subordinated debt section in that lens. But from a company's perspective, you have increasing dilution in terms of your equity ownership as you move down as well. Issuing common shares is the most dilutive to equity investors, but some of these subordinated debt instruments do carry convertible options that could result in some dilution. So let's walk down the list. Starting at the top, we have high yield bonds, also sometimes referred to as junk bonds. Subordinated to junk bonds is mezzanine financing, or mezz for short. And mezzanine financing can come with warrants attached or without warrants attached. Warrants would convert into shares of the company and therefore cause equity dilution. And that's why you can see the dotted line between warrantless and warranted mezzanine debt. Payment in kind notes, or PIK notes, have interest that accrues and is not paid out until the end in one large payment. And finally, a vendor note is put in place when the owner of a business is selling to a private equity firm, and they are going to receive part of their payout for selling the firm later in the future. So it is a form of debt that the company has to repay to that owner who sold their position later. We'd encourage you to do more research onto each of these types of subordinated debts as may be appropriate for you. But being an introductory course, we just want you to understand conceptually how they fit into the capital stack and how firms and investors think about where everything fits together in a company's financing strategy. A company's cost of debt is directly related to how risky it is. And in order to assess how risky a company's debt profile is, there are debt rating agencies that will rate companies. And you can see here in this table, we've provided examples from Moody's, S&P, Fitch, and DBRS of their ratings for companies. And there is a bright line on this table, right in the middle here that we've highlighted, that separates two categories. In the top, you have what's called investment grade. Investment grade is deemed safe for institutional investors with lower risk and lower return. Below that line, there is what's termed high yield and sometimes also called junk bonds, where there's higher risk, higher return, and more fees associated with raising debt. So it's very important to understand, as both a company that's going to be raising money or an investor that's going to be investing in bonds, where you fit on this spectrum, because it's going to be directly related to the cost of debt. Let's take a closer look at mezzanine debt. Mezzanine debt is non-traded, unlike a bond, which is traded, and it's subordinated to the senior debt of a company. It's typically repaid as a bullet, which means it's not amortized. That means all of the principal is repaid at the end. It typically has a combination of cash and accrued interest built into its return, meaning part of the interest is paid out with actual cash, and part of it is accrued and not paid out until the end with the bullet payment. It can also have equity warrants attached, which means it's convertible into some equity upside, so it gets an additional rate of return. That means there's also dilution for the company if it's converted into stock. Let's take a look at the return profile for mezzanine debt. First, there's the cash pay interest. That's the interest that's actually paid out with cash. Then there's the accrued interest that builds and is paid out at the end. That's the contractual return between the company and the investor. Above that, there could be warrants, anywhere from 3 to 10% of the sale of a company at the exit value. And all of that would combine then to give the mezzanine investors a targeted internal rate of return somewhere between 14 and 20%, just as an example. So if you think of the full capital stack with equity investors at the bottom targeting 20 to 30% internal rates of return or higher, then you've got the mezzanine investors at 14 to 20%. And of course, below them, you have other debt investors that are in safer positions with lower rates of return, say below 10% IRRs. Let's take a look at debt repayment profiles so you can understand from a cash flow perspective how this debt gets paid off. Let's start with senior debt tranche A, which is an example of equal amortizing loans. Equal amortizing means that principal is repaid in equal amounts all the way until the end of the loan value when there's no principal left to be repaid. Then we have senior debt tranche B, which is an example of a balloon payment. This type of debt has some amortization payments along the way of principal, which is why you can see the turquoise line going down, but then at the end there's a balloon payment that's left to be repaid. Next you have mezzanine finance and high yield debt with what's called a bullet payment at the end. A bullet payment is the whole amount. You can see that the gold line does not decline as it moves across horizontally. That's because none of the principal is being repaid until the end. It's just the interest that's being paid along the way. And then finally, the last line is payment in kind, or PIK, which has a bullet payment at the end. But you can see that this orange line is actually increasing over time. That's because the interest is not actually being paid out, and hence the term payment in kind. It's accruing and adding to the balance of principal that's owed at the end. So you can see that there's a bullet payment at the end that's larger than the amount that the company started with. In our financial modeling courses that follow in the FMVA curriculum, we'll be modeling a company's debt schedule, and it'll be very important to keep these different debt repayment profiles in mind. Let's look at the pros and cons of issuing equity and using equity capital, and then let's look at the pros and cons of issuing debt and using debt capital. When it comes to equity, one of the main benefits is that there's no interest payments or mandatory fixed payments that are required, so it saves cash flow for the business. There's also no maturity date or ultimate return of capital unless the entire company is sold or liquidated. It comes with ownership rights and control over the business. Typically, this is expressed through voting rights. It also has a high implied cost of capital. So yes, there's ownership, but it is more expensive. And it also expects a high rate of return, which is a combination of dividends and capital appreciation for the investors. It has the last claim on a firm's assets if it's sold, which means it's the riskiest. It provides the most operational flexibility for a management team because there are no ongoing fixed payments or interest payments associated with it. Now let's look on the debt side of things. Debt typically comes with interest payments. It has a fixed schedule, so it is more of a drain on cash flow for a business. The investors have the first claim of the company's assets if it's sold or liquidated, so it's safer for them. It typically comes with covenants from the lenders, though, that require specific financial performance metrics to be met, so it's restricting in terms of operational flexibility. It has a lower cost, though, than equity, which is one of its biggest advantages. The investors expect a lower rate of return than the equity investors because they're in a safer position. It prevents dilution to equity investors. If a company needs more money and it borrows money, that saves it issuing shares, which is dilutive to the equity holders. However, the trade-off of all that is that it can push a company into default and bankruptcy and raise its cost of capital along the way. So as you can see, there are many pros and cons to both equity and debt, and it's up to the managers of a business to find the optimal balance between the two when funding their operations. When businesses decide that they need to raise money, they go through an underwriting process. Underwriting is when a bank or another advisor helps a corporation raise money from investors in the form of debt or equity. The process itself actually involves conducting research on the business and the investment opportunity, as well as building financial models, performing valuation, and then marketing and selling the deal. In terms of the types of underwriting that are available, generally advisors or banks will either provide a firm commitment, which is when they agree to buy the entire issue in the full amount with full responsibility for selling it. So for example, a company needs to raise $100 million, the bank buys all $100 million, and then turns around and sells that to investors. If it can sell the shares for more than it paid for them, it makes an extra profit. However, if it sells them for less, it loses money. Since most banks don't want to take that level of risk, they typically do what's called a best efforts type of underwriting, where they agree to sell and put as much effort as possible into actually selling the entire deal, but are not responsible at the end of the day for any unsold shares. The best efforts type of commitment is becoming increasingly more common. Underwriting advisory services can be broken down into 3 categories. The first is planning. In the planning phase, the investment bank or advisor on the transaction is going to identify the key themes that investors will be looking for in the deal and build out a thesis or investment rationale to help sell the deal. They'll perform financial modeling and valuation work, and then they'll decide if an IPO is the best option or not. Then they can look at the size of the flotation, which is the number of shares to be offered, and get a preliminary view of investor demand to really see if this IPO or other underwriting is going to be a go. Then there's the issue structuring, which is the deal structuring, where you look at whether it's going to be domestic or international with retail or institutional investors. And then finally, there will be some initial introductions to talk to investors and see if this deal can be structured or not. And then the third category is timing and demand. This is where the advisor or the investment bank will really get a sense of how much demand there is for this opportunity. It will depend on a lot of things, both the business itself and what's intrinsic to that business, but also external factors as well, such as what's going on in the broader market. And all of this together will combine to inform pricing for the deal. And in the next lesson, we'll look at how an order book is built and how the deal is ultimately priced and sold. Let's take a look at the book building process within underwriting. It starts with an indicative price range where the advisors and underwriters feel the demand will be. They then go out and meet with institutional investors to get commitments from them at specific prices. And based on those prices, they're actually able to build an order book or a book of demand where they can see where all the institutional investors are willing to invest, how many shares, and at what price. And once they have that book of orders built, they're then able to go through it and set the price, which is the clearing price, ensuring that all of the orders that are needed for the deal will actually be filled. Then they go to allocation. And with allocation, if the deal was oversubscribed, meaning there was more demand than there were shares to offer, then investors will be cut down on a pro rata basis typically. So the idea behind this process is to get as many orders as possible from investors at as high a price as possible, and then ensure that they're able to sell the whole deal at a certain price. One of the most important parts of the book building process is the roadshow. The roadshow is an opportunity for investors to meet directly with the management team. They will have discussions and presentations where they will talk about management structure and governance of the business, the overall strategy, and short-term and long-term tactics. They'll look at funding requirements and the use of proceeds, why they're raising this money, and how they plan to invest it. There will, of course, be a thorough analysis of the industry and sector, including competitors, and key risks will be highlighted as well. The idea in these meetings is to get the investors directly in front of the management team so they can hear from them firsthand the strengths of their business and why they should invest. The roadshow involves booking as many meetings as possible in cities all over the country and internationally so that they can quickly build as much demand for the offering as possible. There are many issues to consider when pricing an offering. One is stability. It's very important to have stability in the secondary market. It's also important to have a lot of investor demand in the aftermarket so that it trades well. And that involves having a depth of investor base that's necessary for a public offering. Let's take a look now at the trade-off that has to be made when the underwriters in the company are pricing the offering. On the one hand, they want to have a strong aftermarket performance. That means they want the price to go up in trading after it's priced. But on the other hand, they want to maximize the price that they're selling shares for into the offering. And there's a trade-off. If they maximize the price that they're selling when the issue is priced, then the aftermarket performance may be weak, and it will be dubbed an unsuccessful IPO. But on the other hand, if it's too successful after the pricing, then that means money was left on the table and they could have sold it for more. Let's take a closer look at the underpricing that happens. There are really two costs of an IPO or flotation. The direct fees, which is the percentage charged by the advisor or investment bank, and then the indirect fees, which is the underpricing. Banks typically want to have some amount of underpricing. It reduces the risk of an equity overhang after the transaction. It ensures that there's a solid secondary trading market, but it doesn't maximize the price for the sellers. Let's take a look at how the IPO pricing really works. You've got the full value of the shares. Then you have an IPO discount and the pricing range. Typically, you have about a 10 to 15% indicative range between the maximum and the minimum. And you're going to be pricing the deal at the end of the day based on a combination of relative valuation of other companies and intrinsic valuation, which is discounted cash flow modeling. But as you can see, there is going to be some level of discount in the IPO pricing so that the aftermarket performance is at least stable, if not stronger than that.